Okay, friends. So, welcome back. The first feature uh, of this form of business organization, which is a corporation or a company, is of course its very definition, which is a separate legal existence, right? So, they have their own name and they can deal in their own name. They have certain legal obligations, they have certain legal rights, right? Which usually other forms of business organization do not enjoy. The second important feature, which is a result of the separate legal existence, is the limited liability of shareholders. So, the limited liability concept is that the responsibility of the corporate form of business is only limited and it cannot be transferred to its shareholders, right? The financial responsibility. That is in case of, assume in case of a sole proprietor firm or a partnership firm that takes some loan from bank and then goes bankrupt. All the partnership for assets have been sold to pay off the loan. The loan is still not paid. Legally, the bank can resort to the partners because you are the people who are running the partnership firm. So you are responsible to pay off the loan. So the personal wealth of the partners can be claimed for the business obligations. Same is the case for a sole proprietor, but in the case of a company, since it is a separate legal entity, so whatever is there in the name of the company is different from whatever is there in the name of the shareholders. So shareholders, although they are partners in the company, they are shareholders, but they have already put their money by buying shares. So that's the maximum they can lose. So if the company goes bankrupt, all the assets of the company are liquidated, sold, all the loans are paid off. Still, if some loan is outstanding, the bank or any other party cannot come to the shareholders that, okay, you were the owner, so pay this loan, right? So because the company is a separate legal entity, so actually the investment in the company, from the perspective of the investors, the shareholders, is relatively safe in the sense that uh, at least their personal wealth is safe, that it will their personal wealth will not be claimed for the liabilities of the business. So this is the concept of limited liability. In the case of a partnership firm, there are three partners. If they want to admit a fourth partner, all the partners must agree, number one. Number two, they must form a new partnership deed, and this will become a new partnership firm. Although the business can carry on, but it will be altogether a new partnership firm. Whereas in the case of company, uh, the shareholders can just sell out their shares. If it is a public company, they can go to the stock market. If this is a private company, they can have some private arrangement to sell the shares, and they will be out of the ownership, and some new owners will come. So that's why in the corporate shareholding pattern, you might see that the people who were owners of the company, a corporation, 10 years back, none of them is owner of the company now today, right? So that's the case for the company, that the company is a perpetual entity because the ownership is transferable. So there are companies who were there 100 years back, they are right now exist as well. Of course, the owners are totally different, but a partnership firm usually cannot actually work in this format. The next one, ability to acquire capital. So uh, since it's a separate legal entity, it wants a new for example, it finds a new opportunity to invest, and it asks its shareholders to invest more money. And if the shareholders deny, then theoretically the company can go to the open market. They can ask for other people to come in and put their money in the company and buy new shares, right? So theoretically, although there are some legal constraints on it, but theoretically, the company can acquire as much capital as it wants. It's not the case in the partnership firm, because in the partnership firm or a sole proprietor, the maximum capital that can come in from the existing partners. You cannot admit a new partner, right? But in the case of a company, you can admit new shareholders, theoretically. And of course, the life of of corporates is continuous, because just like it's very difficult to register a company, to give birth to a company, to get a company incorporated, it's also very difficult to get the company die. So there are too many legal formalities to uh, withdraw the company from legal existence, and that's known as a liquidation or winding up of the company. and there are too many legal formalities that have to be catered for this purpose. So usually companies are, they enjoy continuous life. So you can find companies who were established maybe 150 years ago, but they are still there. The agency problem, which is that the separation of the ownership and management, because the company itself, it's a legal entity, and but it is not a human, so it will be managed by some people who is the management or the board of directors at the very top. uh, so this is the case. So shareholders are the owners, so they are at the very top. Then they actually elect the board of directors. So there is an election in which the directors are elected, and from among the directors elect a chairman. So there is a chairman and the board of directors, and then they hire the CEO and other C-suite officers, vice presidents or CFO and COO, etc., etc. So the vice president usually is the term used in the US, whereas in the South Asia and things like Europe, I think they use the C-suite, which is the chief financial officer, chief operating officer, chief information officer, and they have different departments, everybody of them, and then there are many employees serving under them. So the point is that company is owned by shareholders, right? So at the very top you can see the shareholders. So these are the owners, right? But these are not managing the company. The company is being managed by the board of directors. So here comes the agency issue, that these are actually the ones who are usually paid for their services. These are the ones who enjoy the risk and reward of the business. So there is a clash of interest because they want their salaries, they want their performance to be reflected better, whereas the shareholders want the eventual return from the company. So here comes the agency issue and all the stream and the things we usually know as the corporate governance. So this is the issue conveyed over here, that the corporate management is has some special agency issues to be taken care of. This is not there in the partnership, because in the partnership firms usually one of the partner, at least one of the partner, is active in managing the affairs of the firms, and every partner has a right actually to manage as per the terms of the partnership deed. And for a single owner business, sole proprietorship firm, of course, this is not a problem because he is the owner and he himself has to take care of all the decisions. But in the corporate form, this can be a possibility that none of the board of directors, none of the members of the board of directors is actually a major shareholder, right? Although practically this is not usually not the case. So the major shareholders are also on the board of directors as well. But theoretically, this actually space is there, and at least practically it is there to the extent of at least minority, or what is known as minority interest or non-controlling interest. So there are many small shareholders who are not there on the board. Maybe a larger shareholder are represented on the board. So this is the agency issue. Then the government regulations, too many laws, too many compliances. So if you form a company, then every month you have to file certain returns to the SECP, to the Securities and Exchange Commission. In case of Pakistan, it is SECP. For the tax laws also require corporates to file more returns, more obligations, and every quarter there are certain obligations, the obligations to disclose your financials for audits, etc., etc. And additional taxes as well, because since company is a legal entity, it means whatever the company is earning, the company has to pay tax. And then eventually the company distributes its profits to shareholders. So shareholders are again another entity, the citizens, so they have to pay tax. So the same profit is, it's usually called, it's actually tax twice in the case of company. The same profit, if the same business earns the same profit, but it's not a company, it's legally it's formed as a partnership firm or a sole proprietorship firm, it pays tax only usually once. So although tax regulations are different across countries and there are many tax credits available for this cause out of double taxation, but the point is that theoretically this exists. So these was some of the features of the corporates, and in the next video we shall see how to form corporates. Thank you.